The current live price for Kraft Heinz Co., trading under the ticker KHC on the Nasdaq, is $22.46 USD, which represents a significant intraday drop of 1.30 USD or 5.45% during this Wednesday session on January 21, 2026. This move is not just another daily fluctuation in the consumer staples sector. It is a clear signal of institutional exhaustion that has sent shockwaves through individual brokerage accounts across the country. While many investors woke up expecting a quiet day for a defensive stock, the reality is a brutal revaluation of one of the most famous names in the American pantry. The headline pulling the rug out from under the stock today is the news that Berkshire Hathaway has filed a prospectus supplement that could allow it to sell its entire stake of over 325 million shares. This is essentially the ultimate vote of no confidence from the house that Warren Buffett built. For years, the market assumed Berkshire would be the permanent floor for this stock, but under the leadership of Greg Abel, it appears the firm is finally ready to walk away from what has long been described as a difficult investment. The expectation for Kraft Heinz has always been that it provides a safe harbor during times of market volatility, yet the reality we're seeing today is a stock hitting a 5-year low, crashing past levels we haven't seen since the pandemic panic of 2020. This creates a massive curiosity loop for anyone looking at their Robinhood app or checking their Fidelity investments today. Why would the largest shareholder, owning roughly 27% of the company, choose this exact moment to signal an exit when the stock is already at multi-year lows? The common ground among many retail investors is the belief that a 7% dividend yield makes a stock like this a buy and hold forever. However, the deeper reality is that Kraft Heinz is facing a structural crisis where its cost-cutting legacy has finally caught up with its ability to grow. When you see institutional giants like Berkshire prepared to dump 27% of a company, it suggests they see a future where the dividend might not be the safety net everyone thinks it is. Looking at the immediate trading activity, the volume today is more than double the daily average, showing a frantic rush to the exits as the news of the Berkshire filing spread. This selling pressure isn't just coming from the big guys. We are seeing high activity on platforms like Interactive Brokers and SoFi Invest as traders try to get ahead of what could be a massive supply overhang. If Berkshire actually begins offloading hundreds of millions of shares into the open market, the downward pressure could be relentless. This comes on the heels of several analyst downgrades this week. Morgan Stanley recently moved the stock to an underweight rating, and today Jefferies lowered their price target to 23 USD. The technical picture is equally grim. The stock has decisively broken below its 50-day and 200-day moving averages, and with today's drop, it is essentially in price discovery mode to find a new lower floor. The pressure on Kraft Heinz is happening in a vacuum. The broader packaged food industry is struggling with a new set of challenges in 2026. We are seeing the lagged effects of tariffs starting to hit the bottom line as the cost of imported ingredients and packaging materials rises. While many thought inflation was cooling, the reality for food producers is that sticky costs are staying high, while consumers are finally pushing back against price increases. On Fidelity trading platform and within Schwab Intelligent Portfolios, we are seeing a shift away from these old-school staples into more agile companies that aren't weighed down by massive debt and stagnant brands. Kraft Heinz has a debt-to-equity ratio that remains a concern for many, even after years of trying to clean up the balance sheet following the disastrous 2019 write-downs. Please comment below with how many shares of Kraft Heinz you currently hold, or if you have completely moved out of the consumer staples sector this year. I am curious to see if the high dividend is still keeping you in the trade, or if the Berkshire news was the final straw for your portfolio. The business model of Kraft Heinz is built on iconic names like Oscar Mayer, Vlasic, and of course Heinz Ketchup. For a long time, the strategy was focused on extreme efficiency and cost-cutting, a hallmark of the 3G capital era that initially merged the two companies. But you can only cut costs for so long before you start to starve the brands of the marketing and innovation they need to stay relevant. In 2026, the company is attempting a massive strategic pivot by planning to separate its global sauces business from its North American grocery segment. The idea is to isolate the high-growth sauce brands like Heinz and give them a higher valuation multiple, while the slower grocery business handles the steady but unexciting products. It is a move designed to create value, but the market today is saying it might be too little too late. Investors using online investing tools and self-investing platforms are looking for growth, and Kraft Heinz has struggled to provide organic sales growth for years. When we look at the historical context, Kraft Heinz has been a source of frustration since the merger. It was supposed to be a powerhouse of scale, but instead it became a cautionary tale about the limits of financial engineering in the consumer goods space. The company has taken massive impairment charges in the past, and while management has worked hard to improve the operational side of things, they are now fighting against a consumer base that is increasingly looking for fresher, healthier, or private label alternatives. On investing sites and within Fidelity wealth management circles, the conversation has shifted towards whether these legacy brands can actually survive the new dietary guidelines that were recently introduced, which place a much heavier emphasis on reducing sugars and processed foods. For those using a SoFi active investing or interactive brokers trading tools, the future outlook for KHC now depends on how the Berkshire exit is handled. If it is a slow, orderly sell-off, the stock might find a base, but if the market anticipates a block trade or a constant stream of selling, it will be very hard for the stock to mount any kind of meaningful recovery. There is also the risk that other institutional holders, seeing Berkshire leave, will decide to follow suit. We have already seen insiders selling shares recently, including a notable sale by Miguel Patricio back in December. This internal and external selling pressure creates a ceiling on the stock price that is very difficult to break through. The macroeconomic environment in 2026 is not doing Kraft Heinz any favors. With the potential for a recession still looming at a 35% probability according to some major banks, a defensive stock should be doing better. But the high interest rate environment of the past couple of years has made the dead load for companies like this much more expensive to service. When you can get a 5% return on a government bond, a 7% dividend from a company with shrinking sales, and a massive shareholder exit doesn't look as attractive as it once was. This is why we are seeing such a violent reaction today. The safety narrative has completely been dismantled. In summary, the reality for Kraft Heinz today has completely failed to meet the expectations of stability that investors usually associate with the name. The move by Greg Abel to potentially exit Berkshire's massive position has changed the fundamental story of the stock from a safe dividend play to a high-risk turnaround. We have seen a 5.45% drop to 22.46 USD, a break below critical support levels, and a surge in selling volume across all major platforms from Robinhood stock trading to Fidelity brokerage accounts. The contrast between the belief that these brands are indestructible and the reality of institutional abandonment is what is driving the volatility. Moving forward, the key catalysts will be the official quarterly earnings report in February and any further filings regarding the Berkshire sale. Investors should be extremely cautious, as the supply of shares hitting the market could keep a lid on any upside for a long time. The authority of the Berkshire seal of approval is gone, and Kraft Heinz is now on its own to prove to the market that its brands still have value in a rapidly changing world. Whether you're using SoFi active investing or managing a Fidelity IRA, the lesson here is that even the most legendary investments have an expiration date when the underlying business reality shifts.